Did you know that real estate was amongst the first investments to recover in both the 2008 and 2020 recessions? Real estate investing has always been a great place to put your money as you get to collect rent and participate in the increase in property value. In today's list, we have two names that pay over 6% in dividends. In addition, owning something real, tangible, like apartment buildings and office spaces or shopping centers, provides a sense of security and stability, especially in times of economic uncertainty. But how do you find the best real estate investments to take advantage of the looming recession worries and the potential of a recovery in the real estate market after the recession? Well, if you haven't heard about the topic in today's video, don't worry. I will explain what a real estate investment trust is, otherwise known as a REIT, very shortly. But before I do, there is something very different about today's list. All the stocks in today's list aren't just about owning buildings and collecting rent. Their involvement with the properties they own go much deeper than that, contributing to innovation and a real competitive advantage within the industry of the buildings they manage. All of these pay a dividend, and you can add them to your portfolio and start collecting a dividend today. All of these companies are prepared to weather the recession and are positioned well for increases in share price as the market recovers. So what is a real estate investment trust? Now, buying physical property can be really confusing and costly for individuals. That's why a great alternative is a real estate investment trust, or a REIT. A real estate investment trust is an investment that owns and manages income-generating real estate properties. Now, REITs were created so that individuals, not just people who had a lot of money, could invest in and take advantage of real estate properties. This means that the value of a REIT is closely tied to the real estate market, and REITs are required to give back most of their profits, at least 90%, back to their investors in the form of dividends. And today's list includes only those you can buy and sell on the stock market. Here's a fun fact. The first real estate investment trust was created in the United States in 1960. The REIT, called Equity Industrial, was founded by Robert F. Lowry and Samuel Thiel, and they focus on acquiring and managing industrial properties. Now, why would you even want a REIT? REITs have historically low correlation with stocks and bonds, which means that when the market moves up and down, REITs tend to march to the beat of their own drum. But how do we find those that will not only do well in a recession, but be amongst the first to recover? Well, that's exactly what the list of 5 are today. First on our list, a company that provides Amazon with their warehouses so that they can get packages to you in 2 days. We have PROLOGIS Inc., ticker symbol PLD. Now, PROLOGIS Inc. is one of the largest REITs available to buy on the stock market. They own and operate over 984 million square feet of logistic facilities. PROLOGIS works especially hard in the management of logistics, or the business of getting things that people order to them as fast and as cheap as possible. PROLOGIS has worked with its customers to deploy advanced automation and robotic systems within their properties. They also have invested and developed smart logistics technologies, such as real-time tracking and monitoring systems. It's not a surprise that some of their biggest customers are Amazon and FedEx. Additionally, they do not just have properties here in America, but across 19 countries around the world, allowing them to bring ideas from all over the world to help better their customers and their own business. With the growing want of getting the product to the customer faster and faster, PROLOGIS is a great investment for when the market recovers and people are spending again. Now, what makes them a strong buy, however, isn't just their dividend, which is a 2.78%. It is the fact that over the last 10 years, they have returned annually a total return of 16.6%, which beats the total return of this S&P 500 of 13.2%. So they are definitely a strong buy if you're looking for a strong track record and a high dividend. Next on our list, we have a company that helps with communication, Crown Castle Inc., ticker symbol CCI. Now, Crown Castle is a telecommunications infrastructure company that operates and leases wireless and broadband infrastructure. Sounds kind of confusing. Have you heard of T-Mobile, Verizon, and AT&T, the biggest 3 companies that do this type of business in America? Well, they're all Crown Castle's customers. Crown Castle owns about 40,000 cell towers, and they have more than 80,000 miles of fiber optic network all over the United States. So your internet at home may run on lines owned and operated by Crown Castle. Your service provider like T-Mobile, Verizon, or AT&T might just be paying rent to Crown Castle to use it. Now, in a recession, people tend to give up certain things. Can you imagine giving up your cell phone and internet? Thought not. This means that their company and business will be okay no matter what happens to the economy. Now, one interesting thing about Crown Castle is that they have actually been very innovative with where they've been building their infrastructure. They believe in bringing high-speed broadband internet to underserved areas in the United States. They have named this program FIBERHOOD. Speaking of helping where it matters most, Crown Castle also has a strong focus on sustainability and environmental responsibility. And they have worked and partnered with AT&T to install solar panels on towers. They've worked with Verizon to deploy energy-efficient equipment at all their cell sites. With this, you can tell that Crown Castle is positioning well for the future and is looking to make the environment one of its prime focuses in the future. That, coupled with its 4.57% dividend, makes it a great addition to any portfolio looking for income. Next on our list, we have Ventus, ticker symbol VTR. Now, Ventus is a healthcare REIT. Ventus manages all kinds of healthcare related buildings like senior housing, medical office buildings, hospitals, and rehabilitation centers. Now, what makes Ventus unique is that they also work with the Mayo Clinic to develop a number of different medical office buildings around the USA. Leveraging the expertise and resources of other organizations, Ventus can create high quality healthcare properties. And healthcare isn't going anywhere. Ventus not only has properties in America, but also Canada and Mexico and in the UK, giving them access to information from other countries and the ability to provide an innovative approach to healthcare from a global perspective. And with innovation, Ventus is definitely doing their part. One of their unique properties, called Watermark at Logan Square, is a senior housing community in Philadelphia that features a rooftop farm and a state-of-the-art fitness center. Watermark focuses on wellness and sustainability for all of their residents. Ventus currently pays out a 4% dividend yield. Now, we still have two more REITs on our list, and both of these offer more than a 6% dividend yield. Be sure to take note of those for your research. Next on our list, we have Physician Realty Trust, ticker symbol DOC. Yes, it is another healthcare REIT, but this REIT primarily focuses on acquiring and developing healthcare properties like medical office buildings and outpatient clinics. Physician Realty Trust owns more than 200 medical office buildings and over 50 outpatient clinics. Unlike our previous medical REIT, Ventus, which builds new properties, Physician Realty Trust focuses on buying medical buildings and making them better. While they are a relatively new company, only being listed in 2013, they have already made great progress in both their business and their passion for company culture, being named one of the best places to work by the Milwaukee Business Journal, and they are included in the Fortune 1000 list of the largest companies in the United States. DOC, Physician Realty Trust, is a company that is in healthcare and in sustainability, and being a REIT makes them a great stable investment to add to any portfolio. Oh yeah, they also have that wonderful 6.3% dividend yield. Next on our list, rounding out the healthcare sector and today's top 5, Healthcare Realty Trust, ticker symbol HR. Now, HR is in much of the same business as Physician Realty Trust, but it's a little bit older. They began their journey in 1992, and they own and operate over 250 medical office buildings and 30 outpatient clinics. Healthcare Realty Trust does value the environment and has a passion for making their buildings more sustainable by installing solar panels. HR differentiates itself by building strong relationships with the medical professionals who work in the buildings by providing support and resources to help those physicians and professionals succeed in their business. Healthcare Realty Trust has partnerships with healthcare systems like the Vanderbilt University Medical Center and Duke University Health Systems to develop and manage healthcare properties. HR has a strong track record for growth and has been recently buying up more medical REITs. HR, like our previous healthcare REIT, is positioned well and with a little bit higher dividend coming in at 6.61%. This might be the name you're looking for to add to your portfolio of dividend stocks. Now that completes our top 5 dividend stocks. For more dividend-paying stocks, be sure to click the playlist for all the top dividend stocks that you might want to add to your portfolio. We'll see you there.